All right, so economists are warning us that next year, the 2023 recession is about to get bad. But the good thing is no matter how bad things get, they'll never be as bad as this magic trick. Now, speaking of credit card debt, it's a smooth transition. Credit card debt has reached almost an all-time high. Our personal savings rate here in the US has reached almost an all-time low at 3.1%. And even though inflation is finally starting to come down, it's not coming down quick enough. We are still at 7.7%. Now, tech companies have also started their hiring freezes and their layoffs. Twitter has already laid off 50% of its workforce, and Elon Musk is warning us that Twitter could potentially go bankrupt. Now, the downside is a lot of people are going to lose their jobs. The upside is no more Twitter. Now, tons of other tech companies have also started their layoffs, including Meta, Stripe, and Salesforce, with roughly 13% of their employees, along with a dozen other tech companies. Now, Wells Fargo reported probably the scariest thing, because mortgage loans are down an astonishing 90%, which is just mind-blowing. And rent delinquencies when it comes to small business owners is now up to 37%, which means roughly 1/3 of small business owners can't afford to pay their rent. But the worst that's been affected the most by this are the restaurants, with roughly half, or 49%, that couldn't or did not make their payments as of last month. And to make matters worse, the spread between the 2- and 10-year Treasury bond yields has inverted since July. And if you look at the historic chart, that means if this line drops below the zero horizontal line right here like it already has, it has reliably almost always predicted that a recession is ahead. Now, believe it or not, 75% of voters already believe we're in a recession, but according to the president, we're nowhere near a recession. So are we in one or not is a question I still can't believe we have to ask, but in today's video, I want to separate some of the fact from fiction and show you some new economic indicators that have reliably predicted that a recession is ahead. I promise this one is going to be some new data that I've never shared with you before, so let's get right into it. Hi, my name is Andrei Jikh. Hope you're doing well. Come for the finance and stay for the fun facts. Here's a fun fact. Did you know that Amazon just became the world's first company to ever lose $1 trillion worth of value? Yeah, Bitcoin's like, hold my keys. Now, it's generally agreed on by economists that if there's 2 negative GDP quarters back to back, that's a recession. So far, that's already happened this year, but our third quarter GDP was positive, so maybe we're not in a recession. But have you ever thought, why does it have to be that way? Who decided on these 2 GDP quarters being the measure of a recession, and why couldn't the world just slow down for a couple quarters and not make more and still be okay? Maybe those are silly questions, but they're extremely important in the world of economics, and here's what really helped me understand it. If you think about the world in terms of the population, if you quadrupled us in size, but we continued to make the same amount of food, that would not be a very good thing for the economy. So what the GDP growth actually measures is our demand in relation to the population growth. A country has to make at least as much stuff as its population demands. Now, if the population started shrinking, then the GDP growth wouldn't matter as much. But we're not shrinking. We're growing. 70 years ago, in 1952, there were 2.5 billion people on this earth. But 70 years later, today, literally this week, we are living through history because the United Nations told us that this week we are crossing 8 billion people on this earth. And 70 years from now, we will add another 2.5 billion people to this earth. That's why it's important for economists to track the GDP. Because the more and more people are born into this world, the more and more stuff we have to keep making to meet their demand. That's why the GDP matters. And it's so cool because economics is sometimes so complicated that we sometimes forget what we're actually arguing for. So it's a really cool way of breaking it down. But there's another thing the GDP measures, and that is technological advancement. If we can create a technology that can make us more food, that'll be shown in the data because we're becoming more efficient and more productive, which would be a good thing. But the problem is that human beings need more than just food. We also need cars and jobs and houses and fulfillment, and to make sure that we can afford our lifestyle, inflation. We also have to agree on what those variables are and how to measure them and combine them into one clear picture. So what's so exciting to me about this video is that I'm always looking out for a new data point that could help me predict the future of our growth. And I found a new one this week that I've never heard about before, and it's called the LEI. The LEI stands for the Leading Economic Index, and what it does is it takes a bunch of leading indicators in the economy and fuses them into one polymerization style to give us a picture about what's called the business cycle, 7 months into the future. And the reason that it's so amazing is because it has reliably predicted every single recession as it's defined by the NBER. So first, let me show you exactly what it's trying to measure in terms of productivity, and then I'll interpret the data for you. But I have to warn you, it's about to get insanely complicated, and I'm probably gonna put you to sleep. So if you can make it through this, not fall asleep, and still understand what I'm talking about, you're amazing, because it took me a while. So first, it measures the average weekly hours worked in the field of manufacturing, and that is this chart here, and we just want to see something that's steady, roughly in the 40 hours a week range. If there's a dip, then that's a bad sign. So super simple and straightforward. 2, it looks at the average weekly initial claims for unemployment insurance. Sounds fancy, but all it does is measure jobs, and that's this chart here, and we just want to see a graph that's low or steadily declining because we want to see less unemployment claims. 3, it looks at manufacturers' new orders for consumer goods and materials, which is a long way of saying it's measuring how much companies are putting an order for things that we as consumers would buy. Things like clothing, PlayStations, cameras, lenses, and things like that. And in this chart, we just want to see something that is steady and not dipping like we'd see in a recession. 4, it looks at something called the ISM, or the Index of New Orders. Now, it's sometimes referred to as the PMI, or the Purchasing Managers Index. And what it does is it measures the change in supply chain productions across the whole economy. Sounds complicated, it's just this chart, and if you see a number that's over 50, then that's a good thing because it means new orders are expanding. And if it's a number below 50, that means new orders are shrinking, which is a bad thing. 5, and this is a big one, it looks at the manufacturer's new orders for non-defense capital spending excluding aircraft. Void where prohibited, exclusions apply, except in Indiana. I'm just kidding, I made that last part up. But what this does is it looks at the company's orders for things like equipment, which would help them make more stuff. So instead of t-shirts and computers, it would look at something like AI robots to help them build more cars, things like that. And that's this chart here, and we just don't want to see any major dips. 6, it looks at building permits for new private housing units. And the theory here is that when there are more builders building stuff and building homes and apartments, that's when we have more economic growth and expansion because there's more jobs. When there are less building permits and people are building less, there's less opportunity for growth and expansion. And in this chart, we just don't want to see a major decline here. 7, it looks at what's called the S&P 500, which is an index that measures the top 500 companies in the US. And the theory is that the more shareholder wealth there is, the more economic wealth there is. But in my opinion, this should be changed to real estate equity because real estate wealth is a much more accurate measure of the average wealth of the average person. So maybe they'll change it sometime in the future, and if they do, I'm taking credit. And number 8, it looks at the Leading Credit Index, which is an inflation-adjusted measure of the M2, or the total global supply of money. So more specifically, it looks at the availability of credit across the 6 different types of creditors or asset instruments. So I know that did not make any more sense, and if you watch that part again, it's not going to make any more sense, and I'm confused just saying that, but the easiest way to read this chart is that when you see the numbers go more negative, that's a good thing because it means more credit is available, and when you see the numbers go more positive, that's a bad thing because the availability of credit is shrinking. Right now, we are here, which shows that credit is slowly tightening. And that means that's not a good thing. Now, number 9, it looks at the interest rate spread between the 10 and 2-year treasury bonds. The goal here is to see the 10-year treasury bonds offer a higher interest rate than the 2-year bonds. Now, if the two are inverted, which rarely happens, but if it does, that indicates a recession. And so far, our yield curve has been inverted since about July. And 10, it looks at the average consumer expectations for business conditions, which is just a fancy way of saying consumer sentiment. How we feel about the future of the economy has a lot to do with how we spend, which has a big impact on productivity. And right now, it's not looking good either. So that's all the things the LEI looks at, and then it fuses them together polymerization style to give us the full picture. And here's what the graph looks like. This blue line right here represents the LEI 6-month growth rate. The black lines are a warning signal to not go below that, and the red line signals that it's probably going to be a recession. Now, these gray areas are all the recessions of the past, and you can see that every time this blue line dipped below the black lines, we got a recession each and every single time. And as of their latest release, it shows us that we're almost certainly going to be in a recession based on looking at the business cycle 7 months out. That puts us to about the first half of 2023, and it's not looking good because this data predicts that this year our GDP will finish at 1.5% year over year. And the reason that's not good is because in a healthy economy, we should expect between 2 to 3%. So this year, we're gonna do roughly half of what we normally should be. And next year, it's predicting even worse. So we'll see if this data is accurate, but for now, it seems extremely reliable. Now, what I'm really concerned about though is inflation, because last week we got the CPI, the Consumer Price Index, which is the thing that measures inflation, and it came in at 7.7%. And remember, inflation measures affordability, which has a lot to do with meeting our demand. Now, the good news about this is that inflation looks like it already peaked at over 9%, but the bad news is that prices are not coming down fast enough, which means the central bank will likely increase rates again, which will hurt us even more just to get rid of this inflation. If we do get a recession next year, then we can expect the government to increase their spending, to lower tax rates, and to lower interest rates to get rid of the recession. But for next year, at least in the first half, there will be more pain ahead, at least according to the data, and we're living through pretty crazy times. As always, have a wonderful rest of your day. Smash the like button, subscribe if you haven't already. I'll see you back here on Monday, Friday, sometimes a Wednesday, and hopefully we'll all get through this together. In the meantime, I'll see you soon. Bye-bye.